Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. So we're sort of in the summer doldrums where there's not a ton going on. A lot of investors are sort of on holiday. But we did get some economic news this week that will certainly be market driving. Tomorrow, unfortunately, we don't have the data for the jobs report tomorrow, but that could be sort of interesting for the Federal Reserve. The Fed did conclude their two-day policy rate setting meeting this week where they left interest rates unchanged, much to the president's chagrin. Here's the deal with interest rates. I think that there's this perception out there amongst a lot of you and people just in general that interest rates are extraordinarily high and that they're at some point going to come down. We don't necessarily agree with that. Remember, if interest rates across the board come down, most likely that means we are in a recession. And so obviously the U.S. stock market at all-time highs, the housing market at all-time highs, the employment numbers were full employment here in the United States. So, rates don't need to come down. Rates aren't really that restrictive. And so I think this is sort of that Goldilocks situation that, there isn't really a problem. Everybody's sort of looking for a problem with rates, but there isn't really a problem. And so, most likely we all need to get much more comfortable with this rates where they are being normal. And for some of you that are my age or older, you remember that for most of your life interest rates were where they are now or even higher. And so that 15-year period where we saw ultra low interest rates, that was the anomaly. And we don't think we're going back to that. And if we do go back to that, that means some really bad things have happened. So we don't want interest rates to go back to that level. So the reality is, the Fed could be cutting rates on the short end and the long end of the yield curve could still go up, which is the part of the yield curve that matters to all of us in terms of like lending and all of those sort of things. So, I think the Fed is withstanding lots of pressure from the White House, but they're doing the right thing. I mean, the data doesn't call for them to be cutting rates, and so they're not. I don't think the Fed will cut rates at all this year. I guess that is a TBD situation. But the Fed really doesn't need to be cutting rates because the U.S. economy is doing quite fine, as evidenced by what's happening in corporate earnings.
Market concentration now has reached such an extreme that essentially 7 companies represent 40% of the index. Coincidentally, earnings season is actually the same. This week represents about 40% of the entire S&P 500 earnings season. Yesterday, of course, we got the two of the AI heavyweights in the form of Facebook and Microsoft, both reporting double-digit earnings growth year on year. To move the needle double digits on a $4 trillion market cap like Microsoft's is almost incomprehensible to the extent that we're seeing these companies really eating the world. And as we extrapolate that into the future and think hundreds of billions of dollars worth of white-collar jobs are going to be automated over the next couple decades, it's almost terrifying to think how big they're ultimately going to be. But Microsoft became the second $4 trillion market cap company yesterday. The two companies moved a total of $500 billion in after hours in terms of market cap, which means they essentially added a JP Morgan in size overnight, basically. Earnings season, all in all, kind of resembles actually the first quarter where companies that missed are getting absolutely punished, and there's definitely been some weakness in some of the consumer-oriented names. So I think more to come there, and as it relates to tariffs, etc. But companies that beat are being amply rewarded. So it's very much like the first quarter in that regard. But earnings growth on the whole really only matters as it relates to 7 businesses, just like the broader market now, where 77 businesses are approaching half of the entire market capitalization of the United States stock market. But that's earnings season so far, and we'll see more to come as the additional names report today, which really is Apple and Amazon.
And the reality is stocks are expensive, stocks aren't cheap, and so if earnings aren't growing, stocks will be extraordinarily expensive. And so that's why it's so ultra important for earnings to continue to grow with stocks as expensive as they are. So we probably should expect some volatility in the second half of the year because stocks are so expensive. But as long as, like Josh said, earnings are growing, everything is hunky-dory. So as always, if you have questions about your situation or your accounts, give us a call at the office, 800-743-0988, or email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in a couple weeks.